Hello, welcome back to this channel, and today we'll be looking at whether to invest in a debt instrument or to invest in equity instrument. All right, so basically I will just try to explain the two of them. Investment are basically investment that promises you a fixed rate of return, which is like the interest. So basically, whether the business is doing well, whether the business is not doing well, your fixed promised return will continue to come, right? Which is more like the borrowing that you do. So if you borrow money from the bank, for instance, and you want to use that borrowing for a business, right? So if the bank tells you the interest rate is 30% on the borrowing per annum, so whether your business is doing well or not, I don't think the bank really cares. They don't, right? So what matters to them is just that interest that you have promised them, and every time when the tenor matures for interest to be taken, they debit your account and then they take the interest. So whether you're doing well or not, it doesn't really matter here. So what matters is the interest rate that has been promised by the bank. All right, so every time you invest in any debt instrument, basically you are meant to have a constant return, which is called the interest, right? On the other hand, when you talk of equity instrument, right, your return is premised on how well the business is doing. All right, if for example you are a shareholder, for instance, before I get into stocks, if you are a shareholder, for instance, you get return. The return you get is what you call dividend. What's a dividend? Dividend is how much they pay after all the expenses, what they pay to shareholders after deducting. So if you talk about equity instrument is an investment, right, that more like that gives you the opportunity to be a part owner of that business. So if you invest in a particular business, let's say you're a shareholder of a business, right? So being a shareholder means that you're a part owner of that business. So you only get dividend if the company is doing well, because of course, how do you get dividend? Dividend is simply profit after tax divided by the number of shares. So if, for example, profit after tax is 100 million and then there are 100 million shareholders, so basically what you're getting is just for every share you have like maybe 1 naira, right? So because 100 million profit after tax divided by the number of ordinary shares that they have. So basically, so it means that at every point in time your dividend is premised on how well the business is doing, that equity instrument. So the same is applicable to stocks. If you buy stocks, for instance, the prices of stock is based on moves alongside with the performance of the business, right? If the business is doing well, you'll see the stock prices going up. All right, so what am I trying to say here? So in debt instrument, right, when you invest in debt instrument, the returns are stable and you can easily plan your cash flow along the return because it's fixed, it. All right. On the other hand, equity instrument, if you invest in equity instrument, the return is not, except you want to use historical method, you want to look at the trend analysis of how well the stocks are doing over time. But to predict the future, trend of the stocks is of course based on performance, and anything can happen, and and the performance may just change that will make the stock prices to nosedive and all of that. So basically, that's the difference between investing in equity instrument or investing in debt instrument. And another thing is, if you're a shareholder of a company and that company fails on the long run, right, what happens is you can lose your entire money, right? But if you invest in debt instrument, if anything happens, right, the first thing they would do is to settle debt holders, depending on the ranking though. But of course, debt holders will always have a priority, will always have preference before the equity holders. Thank you for watching. See you in the next video. Bye bye.